Hey guys, this is Emmanuel Chris, another video on Dividend Growth Stocks. This is video part 2. If you didn't watch part 1, I really recommend. I talk about PE ratio, the EPS, dividend growth rate, payout ratio, current ratio, debt to equity ratio, the balance sheet, cash flow statement, income statement. Very important stuff. So I really recommend. The quality is not the best, but I'm trying to improve slowly on the editing videos. It takes a lot of time, and I don't have a lot of time. I'm in college full time, second year of finance, and I'm full time working with real estate and in the military too. So it's really hard to find time to do everything. But if you didn't watch the first video, I really recommend. On the second video, I'm gonna talk about annual reports, which is very important. Some qualitative analysis in the stocks, and I'm going to talk about how important the dividend safety, some website I use to find the dividend safety, the intrinsic value of the company, some apps that I find very quickly, the intrinsic value of the companies, the price to sales ratio, the PEG ratio, and the balance, cash balance of the companies, how much cash they have on the side as an emergency fund, which is very important for a good company that's not gonna cut the dividends, is not gonna go bankrupt. In the meantime, I make this video in April 2020, so it's in the middle of all this craziness that's going on in the market. So this is a very good video. And I'm not a financial advisor. I'm just showing all my knowledge that I learned, and I'm just sharing because when I first start, I had people help me out with videos, and I'm just giving back. So I hope you enjoy, and if you enjoy, subscribe and smash the like button. I'm gonna continue where I left off, but I was talking about Broadcom, ticker symbol AVGO, and I talk about the stock as an example. I show you the P/E ratio, the dividend yields, the dividend rates. I show you where I go, how I look, the dividend growth rate, the payout ratio, the current ratio, the debt to equity ratio. So all those things are very important when you pick a stock. But also there are some other things that I didn't talk about, I didn't show, and I'm gonna continue where I left off. But before that, I want to do a recap on what I show. So basically, I was showing Broadcom, and when you go analyze those stocks, you have to do a qualitative analysis and a quantitative analysis as well. So the qualitative analysis, you need to look at the 10K, the annual report of the company, and see what the company is all about. You know, the history of the company, the management, the moat, if the company has a market advantage compared to its competitors. Here in Robinhood, you can look at some of the description about the company, but you have to read more than just this little review. So for that, you should go to the 10K of the company, which is the annual report, and I'm gonna show how to get there. The PE ratio here, you want to get a company with a low PE ratio compared to its growth. With the case of AVGO, they have a very high growth. So because of that very high growth, it's okay that they have this PE ratio at 39, because you want to look the forward PE ratio of the company. So if the forward PE ratio doesn't decrease, then the company is overpriced. But right now, the company should be trading fair value of $310 and it's traded at $234 with a dividend yield of 5.48, which is really good. If you look at the history of the dividend yield of Broadcom, you're gonna see that this is the highest dividend yield this stock has been traded off. And you want to look the historical PE ratio too. It helps. If you see that the company has room to grow, it would justify this PE ratio. Otherwise, I would like companies with a PE ratio below 15. Even as a forward PE ratio, you want some forward PE ratio close to 15. So let's look here. Let's go to Yahoo Finance. And when we look here, we can see that in 1 year estimate 293. So the analysts estimate that in 1 year the stock will be worth 293. Right now the stock is $237. The dividend, it's 5.81, as I mentioned before. This is the TTM, P ratio TTM. This means the past P ratio. On the desktop, this website shows the forward P ratio. Let's look another app here, Seeking Alpha. And go to key data. Yeah, here shows a lot of information. Here shows again the trail P, the past P ratio. But it shows the growth here 7%. Shows the dividend yield, and it shows the growth of that dividend past 3 years and past 5 years. Past 3 years, 64% every year. They've been growing the dividend. And the payout ratio is still under 60, even after all this, even after the dividend yield be almost 6%. And that's a very low payout ratio for the how high the dividend yield is. So that's something you want to look for. Let's go to Guru Focus. Try to find the forward PE ratio of this company. The desktop version you can find very easily, but on the phone it's a little harder. Okay, so Broadcom here, PE ratio at 39, but the forward PE ratio it's only 10.76, which is way below 15. And that's what I'm talking about, folks. Sometimes companies like that, that it grows so fast, you need to look the forward P ratio. For companies like, for example, Walmart or Coca-Cola, that don't grow as much, then you want those companies with a P ratio below 15. And I really like Guru Focus. It shows a lot of information here. It shows price, sales is good. This is like for companies that rely a lot on sales of products. So that's a way, like for example, I would try to evaluate Tesla, for example, because Tesla, it's a speculative stock, so they're not making profit yet. But how you can try to find a value for Tesla, you use the PS, the price to sales ratio. The thing I like here is the analyst estimates. I like to see the EPS on the next years. So yeah, as you can see, the EPS for 2020 is estimated at 942, and then look at how it jumps to 1373 in 2021 and 1283 in 2022. As you can see, October 22, the estimate's lower than October 21, but still higher than October 2020. So sometimes, 1 year, like the EPS just jumps way too much, and then it goes down a little bit. But as long as it goes down and it doesn't go down below what the last 2 years were, which is like 942, then it's okay. But you can go for the annual report. You have to go to the website of the company. So you go here to Google. I like to put the company name, 10K. And see, here's the website of the company. Annual reports from 2006 all the way to 2019. So if you have the time, you can read all of those and compare, 1 year to the other. But as you can see, the 2019 is 192 pages, and that's something that you need to take the time and read everything. To be honest, I don't have the time to read every annual report from every company that I invest. I have about 60 companies in my dividend stock portfolio, and I'm not gonna lie, I haven't read all the annual reports. I have read all the financial reports, and I use Seeking Alpha to to read all the financial report now, the balance sheet, the income statement, and the cash flow statement. But to read the whole annual report, like 192, you can see the pages and you can see business, risk factors. Risk factors are very important. It's very important to review that. All the companies, they have to put the risk factors. It's required. In part 2 here you see a lot about the financial statement. Here, item 7 alpha, quantitative and qualitative disclosure, and you have financial data. It's pretty cool. Show here page 36. Yeah, page 37. So here they compare if you invest $100 in November 2014, if you invest $100 in Broadcom compared to $100 in S&P 500, $100 in NASDAQ, and $100 in the semiconductor index. And you can see here at the end that Broadcom beats all of them, even the semiconductor index, even that they beat it. So if you invest $100 or any money in November 2014, and then you wait 5 years until November 2019, you would almost 4x in Broadcom. So almost, quadruple your investment compared to 168 in S&P 500. That's over 2 times more than S&P 500. So you can see that it was a very good investment for whoever bought it back in 2014. Of course, you cannot just rely on past data. You cannot expect that they will perform the same in the future that they perform in the past. So that's why you have to look the training of the numbers and do a qualitative analysis of the management, inside buying, and make sure it's a good investment. But the way you do that is by reading all these annual reports here. Take your time, read. But there is a lot of tools you can use. One thing I like here on Guru Focus, if you go, it's not available on the cell phone, but if you go on the desktop version, they have a tab that says DCF calculator, and you can go there and they have a DCF, discount cash flow calculator, and that can help you to calculate the intrinsic value of the company with a margin of safety, because that's what you want. You want to calculate the intrinsic value of the companies, and then you want to add a margin of safety depending on the business. If the business is extremely safe, like Google, Apple, you can deal with a margin of safety of 20%. But if a business is more risky, you can go with a margin of safety of 50%. Especially in a time like this, the market's so low right now, then you can require a higher margin of safety. Another app I like to use when I feel a little lazy to actually go and calculate intrinsic value, I like to use Simple Street. I use Yahoo sometimes. I go to Yahoo and I look here, 1 year targets, 293, and then sometimes I go to Guru Focus, and I look here, I see median price for sales. When a company grows a lot, and it's a lot of the case of those semiconductors, you want to look median price, sales value, and and you can see it's a 291, which is very similar to what Yahoo shows here. And you go to Yahoo and you go 1 year 293, you know, it's just like $2 difference. I have an area here just with all the apps that I like to use for stocks. So I use all those apps. Wall Street, get the value here. Let's see here, VGO. So for free, they just they limit for like 10 companies a month, something like that. But it tells a lot of information here. You can learn a lot about the company here. It tells a lot of information. It says here, so it's trading at 26% below its fair value, so that's a good margin of safety. For me, I would like a 30% margin of safety with Broadcom, because I don't consider Broadcom the same level as Apple or Google, for example. Now, so I would like a little more margin of safety. So maybe if the price goes down a little more to 30% below fair value. But look at that, earnings are forecast to grow 33% per year. That's crazy. That's why that PE ratio, it's gonna go from 39 right now to 10% next year because of this growth. I got this stock, some of the shares when it went below 200. You see here in the history here, you see it went all the way to 167. When it went below 200, I was loading the boat on the stock. So I would like to go down a little more. It shows here the returns, and you can include the dividends. But here, this is the part I like. It says fair value 321, and then current price 237, 26% on the value. But I like to go with the price that Yahoo and Guru Focus was telling, which was 291. I'll go with that value instead, and I'll apply a margin of safety on that value. Let's get the calculator here. So if the price was 291, I want to apply a margin of safety of 30%. So I want to get this stock at 70%. Then I want to get the stock at $203 a share, below $203. And as we can see right now, the stock trades at 230, I believe, 234. Yeah, so, and that's exactly what I did. I did my analysis, and I say, okay, if the stock goes below 203, I will buy it. And it went below 203. It went below 200, and I was loading the boat there. And then and right now it's not in the margin of safety I want. I'm not buying right now because of that. Tip ranks. Yeah, I like to look tip ranks. I like to look stock advisor. Go here, tip ranks, and then put. And here you go to analyst activity, and it shows here the price. So the price target's 297, which is very close to Yahoo, which was 293, and very close to Guru Focus, which was 291. So it's very, all these three sites are very close range of price, and then it tells you it can shoot up to 350. That's the bullish case. The worst case scenario 210, and the fair value 297. So then you take 297 or 291, and then you put your margin of safety out of that. So this is the quick way, if you feel lazy, if you don't want to spend time looking EPS Growth, or doing all analysis and stuff. That's a nice way to do like a quick a quick look on the stock. So a lot of times I do that first before I go deeply into the stock and look the finance, the balance sheet and everything. I look like this first, quick look. I hear about the stock and I say, oh, it seems interesting, and I look at those apps, and then I go to Seeking Alpha in the desktop and I look the balance sheet. I go to finance here. You see in the mobile it doesn't show. I have a tab here that shows dividends. I create this tab and I receive information about the dividends of the companies. So when they cut the dividends, when they raise the dividends, so I can keep track. And this is through Seeking Alpha here, because I have my portfolio here on see portfolio, and then you add all your stocks here, and then those companies cut the dividends or raise the dividends, then they will send a notification to you, and then you can filter in your email and create a tab to receive. So another thing very important, you look at Seeking Alpha, is the cash, how much cash the company has. So you want a company that has enough cash to sustain bad situations like we have right now. And if I go over here, get their financials, you see it's not available here because this is a mobile app. So you have to go to your desktop, and then I go to, I'm on desktop version here. I go to finance, key data, financials, and you want to see how much cash this company has on hand. You go to balance sheet, total cash and equivalents here, and you go over here, 2019, $5 billion. So you want a company that has some cash on the side. They should have an emergency fund for business. So if a company don't have an emergency fund, don't have cash on the side, that's a irresponsible company. So I don't like to invest in companies that it's not think about the future. You just think about the present. It's not think ahead. So I don't like that, because it seems like the management team is not very responsible. And with Broadcom, you can see here that they've been increasing the cash amount. In 2015 they had 1.8 billion, and now they have 5 billion. So it's good. Here in 2017 they had 11 billion, but they made a huge investment. They bought a company, its name CA Technology. So they bought this company and they invest some of money on that. But as you can see here, they have $5 billion, and that's good. It gives safety. So this company is not going to go bankrupt. On the other hand, there are some companies that they have no cash on the side, and without a bailout from the government, they'll go bankrupt. So you don't want to be investing in those kind of companies. The last part here, one of my favorite apps, not an app, a website, is a Simply Safe Dividends. This is one of my favorites. So to start a portfolio, I would really advise you to put your portfolio on this website and to see for initially start your portfolio. They give a 14-day trial, and after that I think it's $400 a year. So you can use this 14-day trial and set up your portfolio there. So let's see here. So you sign for your 14-day trial, and then you put here the companies. You create your portfolio here. So let's put a VGO, and then it shows here a lot of information about the income you're gonna get in dividends, the balance for 2 shares, the dividend yield, dividend growth, the diversification, the dividend safety. So the dividend safety is very important. That's how safe this dividend is, and it tells a lot of information about. So no stock has 100% dividend safety. The maximum it goes is 99%, so 98 is very safe. Anything above 60 is good, and a VGO is 67. Anything above 60 is good, so it's considered safe. They've been growing the dividend very fast, 42%. So you can read all the information here. It shares a lot of information here. They decreased the dividend safe because of the exposure of Broadcom with China, probably with the CA deal that they just bought this company. They spend a lot of money, and then you have this situation. It tells a lot of information here of the company. You can learn a lot from see how they've been growing the cash flow. So I really advise you to go to this website. Anybody that has more than $50,000 in portfolio, I would advise to pay, maybe pay the $400 a year for this website. But if you have less than 50,000, I would not pay for this. I would just go and sign up for the free trial, 15 days. But this is very good information here. I love this website. It's a dividend growth strike, 9 years. 9 years without a dividend cut. They start paying 9 years ago dividends. This is the earnings payout ratio. You want below 60. So this is really good. Earnings per share, you see, it keeps growing, very fast rate. It tells a lot of information. I like this part here. It's tell the historical dividend yield. So you want to buy a company that has a very high dividend yield compared to the historical, which means the stock is undervalued. The F.I.R.E ratio the same. You want a P/E ratio that's below this average line, so it means that you buy a stock that's undervalued. And here shows the forward P/E ratio, which is 10.7. We saw that before. The 52-week price range. Again, I bought the stock when it was below 200, so it was close to the 52-week low price. Free cash flow, payout ratio below 50. It tells a lot of information here. I really advise to use this website. If you like the video, smash the like button, subscribe for more content, and I'll be back.